Hey, welcome to Monday Morning Quarterback. It's Monday, February 12th, 2024. A day after the Super Bowl. Last night, Mahomes threw a last second overtime touchdown to win the game. You just can't let that guy in the game, man. You got to put him away when you have your chances. You let that guy hang around, he's going to win every time. That was a pretty good game there. Second half, fourth quarter was definitely good. What are you guys' thoughts on it? Did you guys enjoy it? I know I got a lot of heartbroken San Francisco fans out there. I'm a Raider fan, so I don't even want to hear about Super Bowl losses. So let's take a look at what we got going on here this week. Yeah, so let's take a look at the economic calendar here this week, what we have coming up. On Tuesday, we have a big CPI number. It's a big inflation number. The Fed does monitor this. They really concentrate on core PCE, which is a different number. We expect the consumer price index to come in probably closer to the high threes, fours. With the consumer price index, almost half of it is weighted with what they call shelter costs. And this is a very lagging indicator. So rents and things like that, they're running on numbers that are not only old, but the way the government collects these figures is antiquated. They do it as part of the household survey of the BLS jobs report. If you want to know if rents are going up or where rents are at, you go to the software companies, all the large management companies use, and they know exactly the CoreLogics out there and the Black Knights. They know when rents are going up or not. According to their numbers are 2 or 3% lower than what the Fed has. And if you were to calculate in the real-time numbers, which will catch up sooner or later here in these reports, we're right at where the Fed wants us to be, 2% year over year inflation. Inflation is never going down. It's just slowing down. And ideally, they want it around 2% annually. We're not going to get back that 20% everything went up the last couple of years. We're all making adjustments to it. And so hopefully things pick up here second half of the year for everyone, and we start seeing some growth and opportunity out there. Thursday we have New York Empire Manufacturing Index, retail sales, and continuing jobless claims and initial jobless claims. That's the manufacturing surveys, industrial production, capacity utilization, and then we have the NAHB Housing Market Index. We have some housing data here. Friday we have a producer price index, which is going to show us more of the wholesale side. And oftentimes what you'll see is if inflation may be 7% for us, but the producer price index is much higher. We're seeing these things come down to where we want them to be. By the third or fourth quarter, we're going to start seeing some relief here in these interest rates and be able to help some people out, get them out of these 7% rates. If you're carrying a lot of credit card debt or this inflation has forced you to live off credit cards. Consumer debt is at an all-time high. We're like $1.5 trillion of like credit debt in America during COVID. When everyone had money in their pocket, they couldn't go out and spend it. They paid off all their bills, but then this inflation chewed all that up, and now everyone's worse off than they were before COVID. If you're in a situation like that, it's always worth reviewing your mortgage, how you manage your debt. You may think, why would I go from a 3% to a 6 or 7% interest rate? Why would I do that? When you start talking about blended rates, what you're paying for these credit cards at 30%, when you combine them, your debts, how you structure your debt is going to determine a lot of your wealth building throughout life. So you always want to take a look at it and make sure that you're in the best situation managing your debt. You're always going to have debt there. You're going to be leveraging something, a house, a car. So you want to make sure that it's in the best spot and giving you the most cash flow every single month. If you'd like a review on that, feel free to reach out. Happy to do that for you. We're going to have some more stuff coming out Friday. Building permits, housing starts. It'd be good to see what the builders are feeling. We're starting to see more optimism in the marketplace. We need some houses. We need some people to either sell their houses or build some houses, right? We need some inventory. Let's go ahead and take a look at the charts this morning. Mortgage-backed security is flat, and 10 years up 1 basis point, so relatively flat as well. Quiet Monday. Everyone's got Super Bowl hangover. When we look at the charts here, the higher this mortgage-backed security, the higher these candlesticks go, the lower the interest rates go. So we always want it to higher. That means more margin, lower interest rates. We've broken above several levels here, hung right below this level of support at about 4.196. We've broken above the 25-day, 50-day, 100-day. What do we got left here? We have the 100-day above us. We're above everything else. We got the stochastics, which is going up and down, breaking back above 80. So that could take a turn against us here. So monitor this, see where they go here. We got a lot of support beneath us that this would have to break down under, would have to break below a Fibonacci level, 25-day moving average, 50-day moving average, 200-day moving average. So that's a lot of floors of support. So we're just in pretty comfortable here. Hopefully we get a little push to the upside with a good CPI report tomorrow. Let's take a look at the Freddie Mac rates. Right now they're sitting at about 6.64% on the 30-year, 5.9% on the 15-year. This is a 10-year chart, seeing where the 15 and 30-year goes. Slowly and steadily getting better. And as this inflation gets under control, we're going to see these rates start to come down. And we're going to see some opportunity to help some people out, open up more buying opportunities for those who got priced out of the market with the high interest rates. Although I will stress this, if you have people who can qualify today, they're going to be far better off buying today, even if it's at 7%, and refinancing in 6 months to a year than they are waiting. There's a cost to waiting. If homes appreciated about 5.1% last year, so if you're talking about a $400,000 house and they wait a year, that's $20,000 they just lost. No matter how low that rate goes, they're never going to catch up that $20,000. If their payment's $500 less a month, they're still not going to build that net worth, right? That they're going to be paying someone else that $20,000. And I don't think a point lower is worth paying someone $20,000 for myself. But these things got to be explained for those who are out there. They're going to get the opportunities when these rates hit probably about 5.5%, which they will sometime this year. We're going to see a flood of buyers back into the marketplace. It's going to get crazy. There's not going to be opportunities for our borrowers or our FHA borrowers or somebody who needs a little help from the seller with seller credits, be able to negotiate on a purchase contract to get some help with closing costs to get into a house. We really need to be trying to help those people out now while there's opportunities and educate people on that. And if you need a cost of waiting to show people charts, colorful charts where they can actually see visually, that how much money they lose by waiting 6 months or a year or 2 years, even if rates come down, they're losing net worth. We're going to share those. And if you got any questions, I'll be doing a first-time home buyers webinar Thursday night. If you're interested in sitting in, joining that on Zoom, you're more than welcome. And have a great week and reach out if you need anything.